Well, hi everyone, and welcome to the InvestSMART Bootcamp Week 1 webinar. So, as you probably have realized, that we pace out the content over a period of a 4-week time frame. You can take longer to actually read through and learn at your own pace, but we structured around 4 weeks, and this is the first week webinar that covers off the first 2 modules, and basically you can rewatch others before we do a live one. So if you actually jump forward to next week, you'll see that the previous webinar for week 2 is already up there, or you can register and then watch it during a live session like this one. So you can always add your questions beforehand, or even during this webinar here. Definitely ask questions as we go along. There's a little questions box on the right-hand side. And even if you've got comments or even feedback, I'll take that into account as well. So I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and I also look after the bootcamp. So as always, there's the disclaimer. Basically, this is just general advice only. It's not specific financial advice. So definitely have a read of that. There's a intelligent investor growth fund that's just in the process of being launched. Now, you might have seen this when you've logged onto the website and to the intelligent investor website in particular. And what this is the growth fund that they put together themselves. It's an actively managed fund. So you've got a team of people behind it, analysts like Nathan Bell, and they're actually actively choosing what shares to keep in it. So that's launching. The thing is, it's a initial offer. It closes on the 25th of September. Some of you may have already applied to be part of it. It's limited to $100 million. So that's the amount that we will raise, and then we'll stop and then list when we reach that amount. So you can go to the website and apply now if you think it is suitable. Definitely read the PDS, the product disclosure statement, the fund fact sheet, and also you can contact any of us at InvestSMART Intelligent Investor. We're happy to help. But I'll keep rolling on, and I'll come back to the resources that you've got just in a second too. So what's the purpose of these webinars? They are designed to cover off any questions that you may have from the learning material itself. So as you're going through, you might think, I don't understand this concept, or I don't understand this term. This is something that is the best opportunity for you to make the most of and ask questions that we can put back to you in plain English. So there's no financial advice given. In fact, if you were to ask a question that relates perhaps to your personal situation or something that you're trying to do yourself in a financial context, I would likely rephrase it and try and make it more general, or I might just have to skip past it altogether. It's too specific. We do need to stick to the course content. So although there's probably a lot of questions that might arise to do with future weeks or other modules, it's best to try and stick to this. So I might also skip the questions if they're not directly relevant, or I might answer them on a surface level and refer you either to previously recorded webinars. But yeah, if we've got time, we'll definitely tackle whatever we can. It's also a chance just to make sure that you're using the available resources that we offer. So that's whether it's like the filter tools on Eureka Report or the stock recommendations. It's all about showing you where everything lives and how you can use that to best complement your learning experience on InvestSMART Bootcamp. And this is an introductory course. So we're covering the basics. It's not something where we'll delve deep into financial ratios, calculations, or deep theory on how to price options, for example. So basically, you get, with your bootcamp membership, you get a month's access to Eureka Report and to Intelligent Investor. So what I'll quickly do is I might just actually jump and show you where these live. So on the InvestSMART website, at the top, you've got Eureka Report and Intelligent Investor there. So if I clicked on Eureka Report, it would take me straight to this page. And Eureka Report is headed up by Alan Kohler. So you probably have seen or heard Alan either on ABC News each night doing the finance. In fact, he actually puts all of his charts that he talks about up here on the website. So if you go market strategy and charts, these are all the ones that he would have spoken about on the previous night's news. So I know I always enjoy hearing them explained by him, but it's always interesting having a look at them as well. So again, not only have you got his odd charts there that explain different things, you've also got all the different articles that he and his team put together. So what they do is they will go ahead and interview a lot of CEOs or people who start the companies themselves, the founders. You get behind the scenes access to the questions and interviews that he asks, which is usually a great way. If you're someone who's looking at investing in a particular company, it's a very good chance that Alan has spoken to the important people in that company. And it's a good way to get a background on what they're doing and what they're going to be doing in the future. The other thing that's really handy, and I would absolutely recommend you do this while you've got access, is the Ask Alan section. So if you click on Ask Alan and go to Submit and View Questions, you can actually put your question together and he'll answer them on Thursday, where he'll actually then, I think, post up his live video of answering the questions, or he'll post them here as well underneath. He gets a lot of questions, obviously, so sometimes he may not answer them, or he might refer you back to previously answered ones, like you can see here. And in particular, like I've had a lot of boot campers who wanted more information about bonds, and there's a question here that he looks like he's answered just last week, explaining in more detail what yield to maturity in bonds means. So he's read Liz Moran's articles, which are fantastic. I definitely recommend those as well, and I often refer to them actually in that webinar when I'm talking about bonds as well. So Alan's given his little answer there as well, which is fantastic. The experts part here, you can actually go up and see Elizabeth Moran's articles, and these are the ones that I find very handy to even just brush up on fixed income or conservative deposits or conservative assets, or even bonds, as she talks about in quite a lot of depth. So that's a Eureka Report. So the other side of this as well is Intelligent Investor. So Intelligent Investor is another InvestSMART business, and it's a bit more focused towards the active investor. And what does that mean? Well, it means that basically that's their offer that they're looking at there. I'll just go back. So Intelligent Investor at the top. So if you're someone who loves to read about research, recommendations into companies themselves, and looking at things like ratios or value investing, information that helps you decide whether or not you should invest or purchase a particular share in a company, this is the place to go. So they've got their team of analysts here, headed up by Nathan Bell, who's the head of research. He also runs a lot of their funds that are on here too. And as I mentioned, they're looking at launching their growth portfolio. So previously we had it as a managed portfolio, which meant we look after it at the back end here, and they pick and choose all the different stocks, and then you just invest into a managed portfolio. It's now going to be listed on the ASX. So the Intelligent Growth Fund is listing. If I click on this, this is that page I was just talking about before, where this is where you can apply. It's got the product disclosure statement there, plus more information. There's an interview that Alan Kohler did with Nathan Bell, and some articles that were written. They're also doing a webinar, which if you go down to the very bottom of the page, events, and you can see all the upcoming webinars here. So this is one that's been, it's actually very popular. I was checking it out before, and they've got, I think, nearly 500 people signed up. So it's a really good opportunity to ask Nathan questions directly. You can see past events here. So you'll see some of the webinars I've done with Evan Lucas from the Bunker and Bootcamp. They're intermingled, and actually we'll be doing one coming up, not this Friday, but next Friday, which I'll post shortly on the website. And it's actually looking at investor psychology. So it's designed to complement what you're learning in the bootcamp, but also hearing from Evan Lucas, who is the chief market strategist and has got a lot of experience in markets itself. But if I quickly go back to Intelligent Investor, I sort of digressed, you've got the recommendations. So there's some latest ones here on the side that just talk about different companies and their recommendation, some research, and the analysts are fairly onto it. Like when they get results released, you usually have one of them going through it with a fine-tooth comb and then writing an article about it pretty quickly. There's a recommendations page here with all the latest. The value investing part's very interesting. And as we talk about this in future webinars and even future modules, you'll see how this is highly related to what we talk about in terms of picking shares. So they talk about value investing here, why they think it works, how they go through research, what they mean by buy, hold, and sell recommendations, how do you actually understand them, and the risk ratings as well. So that's very interesting to read. The research alone is something that you could just read for hours, just getting caught up in that. I particularly like it myself. I find it quite interesting seeing someone's opinion on whether a company is a buy or not a buy, or whether just to hold on to it. So you can get caught up in that as well. So we'll just check as we've started. We've got a few questions that have come through before the webinar, which is fantastic. And I'll go through those as we progress with this webinar now. But let's get started with actually what is in Module 1. So Module 1 is all about investment planning. And we do talk about this quite a lot. But essentially, you want to have a goal. You want to take into account the time or the time frame to reach that goal, but you also need to understand your risk profile. The goal, it can be boiled down to simply, what's your reason for doing this? You need to understand what you're trying to achieve from this. I've had in the past and previous jobs I've done, I've worked as a broker, with a broker, and we had a lot of clients who would do trading, and they would often ring us up and ask us for information, trying to, I guess, do better with their trading and make some money. And we'd ask them, the first question is like, what's your goal? What's your actual plan for doing this? What's your reason? And a lot of them would just come back with just to get rich, which understandably, that's all of us. We do ultimately want that, but it's not specific. So your goals need to have that SMART acronym where it needs to be specific. You need to be able to measure it, and that's all listed in the bootcamp as well. So as an example, I'm trying to save for a house deposit. So let's use me as an example now. So time. So how long do I actually have, or how much time do I need to save? So I myself want to buy a house in probably about 3 years. Less time would be fantastic, but I've realized that in terms of budgeting, in terms of saving, I'm going to need the 3 years to get to the point where I can have enough saved for a deposit. So that's my investment time frame as well. In terms of risk, how do I feel about it? Does it keep me awake at night? We've had in the past some clients, particularly at my older job, where they have chosen a high return, but unfortunately they didn't realize that there's a higher risk usually with higher return, and they were in a very short time frame. So some people who were trading in particular were only in the market for a matter of days or months, but they chose an investment strategy that, or assets that required much longer term in terms of years even. That causes so much undue stress, and it can affect other parts of your life. It's just not worth it. I have a fairly good tolerance to risk, but I don't want to be staying awake at night thinking, oh, the market was down today. I've lost a percentage of my funds, my investment. Tomorrow hopefully it'll be up, but maybe it's not. I don't want that extra stress. I want something where I can put my money into an investment or an asset, and I don't want to go backwards. So particularly my example, I want to be able to buy a house in 3 years, so have my deposit saved up. I don't want to have any backward steps. So for me, straight away, I'm fitting myself into more of a conservative or defensive type investment from the outset. So in terms of risk, this is how it, I guess, is categorized. These are the ones that InvestSMART offers. I'm more comfortable talking about these myself just because these are our products. There are numerous other products that you can look at as well. And in fact, on the website, you can actually compare your fund. So if you do have another fund that you want to compare to, by all means, compare it to the InvestSMART ones. But for example, looking at the 4 diversified portfolios that InvestSMART offers, and these are all capped fee as well, which is very important. But we can talk about that a bit later as well. You can see that there's conservative, there's a balanced, a growth, and a high growth. So conservative, you can see that it's suggesting 2+ years time frame. So during this pandemic, I've had a number of friends who have come into lump sums of cash. Unfortunately, not for the best reasons. It might be because of a retrenchment or redundancy. One of them sold a business, so that was good timing for him. And they often have said to me, I want to invest it. Tom, what should I do? And my first, my first question is, what do you want to achieve? What's your goal? What's the time frame you're looking to do that? And also, what kind of risk are you happy to take or handle to do that? And the answers I get back, I guess, unfortunately show how in Australia we don't really have financial literacy. It's not really taught at schools. It's often handed down from parents, sometimes through mistakes made. And I had one friend who did sell his business and he also got retrenched at the same time. So he had a considerable amount to invest. And I asked him those questions and he said, look, I just want to pop it in something for 1 year and I want it to increase in value. What should I do? And I said, automatically, that puts you in a very conservative approach. You don't want to put something where it's going to be speculative or risky. And if you risk losing something over that 1 year period, you won't have the chance to get it back. He turned around and said, well, I was thinking about putting it all into Bitcoin, which I immediately said, look, that's pretty much akin to gambling. It's very speculative. If you're going to do something like that, you don't ever want to put a very, very tiny amount that you could afford to lose into something speculative like that. So it also made him reconsider what is his goal. And he decided that, well, he also wants to save for a house deposit. He's got a bit more cash than I do saved up. So in the end, a conservative type approach of 2+ years seemed to work out better for him as well. And these are all examples. They're not something that you should sit there and say, oh, they directly apply to me. These are just general advice type scenarios. So definitely take that into account. One thing, there was a question we had that was placed before the webinar, and it was from Irene, and she was asking, do you have financial planners that can help me with my investment goals when I'm still new to this idea? So InvestSMART itself doesn't. We don't have a financial planning service, or we don't have any financial advisors who give advice. It is good to go and talk to a financial planner or financial advisor. They're basically the same thing. They're someone who is an expert and is licensed and can give you proper advice on what to do. The biggest catch is, though, you want to make sure that you see someone who charges a fixed fee or a fee for service. Unfortunately, they have a bit of a bad rap where you find a lot of advisors or planners wanting to put you into different investments that benefit them directly. They also might charge you uncapped fees, so percentages based on your entire investment, which can quickly add up, and they range between, they sit around 1 to 2%. So if you've got $1 million, 2% of that is quite a large amount, which you pay them every single year. So definitely, consider seeing a financial advisor or planner, particularly if you want to get a statement of advice. Now, a lot of them should just charge a fixed fee or a one-off fee for that. And you can go back to them, yearly and get that reviewed and just pay that fee. But just try and be careful when it comes to financial planners that are wanting to charge you fees continuously. They don't have any kind of ceiling. That's where you can get into trouble, and a lot of your money or your potential for compounding growth starts to disappear. That being said, if you are able to go through, say, this course, and if you can work out what your goals are, and you can have multiple goals. This, as we've mentioned, I might have a goal where, I do have goals where I'm trying to save for a house, but I also have a long-term growing my wealth type goal. We try and do it as best as we can on InvestSMART without giving you advice directly. And we do this through having a portfolio manager here up at My Portfolio. Obviously, this boot camp, which will talk through concepts. We have tools such as calculators like saving for a property. So you can enter in how much you've got saved, how much you can contribute per month, what kind of portfolio might be able to help with that. We have our own portfolios here that deliberately track different underlying assets or markets. They cap the fees so the money stays in your pocket, and there's different types you can choose from as well. So if you're able to, know your goals, your time frame, your risk. So if you've got a plan, you could also consider going down that path as well. But always consider the potential of going to see a financial planner as well. Just make sure that they are taking you for a ride. And there's plenty of good financial planners out there. In fact, if you Google fixed fee financial planner, you'll probably see a lot of them, not too many, but a lot of them that do offer that service. So I would definitely recommend looking at that kind of service myself. So the other part, or second module in this webinar in week 1, is the diversification part. Now, diversification, asset allocation, they might sound a little bit complex and confusing, but basically diversification is just trying to spread your risk across different assets. So the most popular, metaphor analogy is that you don't want to put all your eggs in one basket, but I like to use my grandfather as an example. He's like many Australians that we see, and has put a lot of his, or he did put a lot of his money in companies that he was familiar with growing up. So for example, I remember when they started to list Telstra, and he went out and bought a parcel of shares in the IPO. And I remember him saying to me, yep, I'm an investor now. I've got my money invested in an Australian company. I'm very happy with that. The question is, was he diversified? Well, absolutely not. He was completely exposed just to Telstra itself. So any movement in their share price, which in hindsight we obviously can see there was, it basically impacted on his whole investment portfolio immediately. So if Telstra had a bad day, his portfolio had a bad day as well. If it had a good day, well, then his portfolio had a good day also at the same time. And I remember we spoke to him and said, look, you need to not have all your eggs just in Telstra, maybe put into some other companies as well. And he turned around and he bought some Commonwealth Bank, which was good at the time because it was one of the banking stocks, Australian. He knows all about that. Was he still diversified? Well, unfortunately not still. He has basically exposed himself just to the Australian market for a start. So he's only spread across 2 sectors in that market. So if either of those 2 sectors had a bad day, or if the Australian market itself had a bad day, his portfolio would have a bad day as well. So what does that mean? Like, at what point are you diverse? Is it when you buy more than 2 shares? Is it when you buy 200 Australian shares? Well, that's a very good start, and that's something that we do at InvestSMART, is that we spread any kind of exposure to Australian shares over the top 200. But then also, do you want to look at international shares? Like, international shares have performed very well in the past. Not just US shares or European shares, but also Asian shares such as Hong Kong and Japan, for example. There's others there too. But what about fixed interest or cash, like a defensive type side of his investment portfolio? Well, he had a little bit of cash just sitting in the bank, not doing too much, but could he have done better with it? And the answer, unfortunately, in hindsight, is yes, he could have done all of this. And this is, I guess, the crux of diversification. What we were talking about just then is diversifying, and it basically just means choosing different asset types to put your investment or your money into. And this has, I guess, a term, asset allocation. And if we look at two of the portfolios that InvestSMART offers, you can see on the left there's a high growth, and then on the right there's a balanced. So high growth, immediately, if you're thinking that its goal is to give you a higher return, it's very likely that it's going to be higher risk as well, and usually in more aggressive type investments such as equities. And you can see there straight away that the cash that you put in, 43% is going to go into international equities, so international shares, US, European, Asian. But then there's also 39% that's going to go into Australian shares as well. So it's quite heavily weighted or allocated towards shares which are higher growth, higher risk in their nature, and therefore need a longer term to ride out any ups and downs. But because it's diversified, you can still see it's got a foot in the door for property and infrastructure, some sitting in cash, and there's also a fixed interest component. Whereas on the other side there, you've got balanced, and it's a little bit more balanced in terms of there's a third of it sitting in fixed interest. There's about just under half in equities, and then cash and property and infrastructure. And that's what we mean by asset allocation. There's a good question I had that came through here as well before the webinar, and it probably is better off suited to the next week, where we talk about investment vehicles or things that you can invest in or assets. And some industry funds offer access to private equity, infrastructure, and alternatives. What's your view on these asset classes? And it is a good question. Recently, we had a webinar with Evan Lucas from the bunker, and I believe you can find it in the bootcamp content itself. And we actually spoke about some alternative investments, particularly we talk about gold, we talk about artwork, even vintage cars. You might see a lot of emails or advertisements pop up on investments like that. And what we spoke about was there's something that you can consider. Do you want to put a big chunk of your cash or investment into that? Well, maybe not. You maybe want to have a small amount looking at that area. So with traditional investments like the ones we've got in front of us here, what they basically have the characteristics of is that they are usually quite liquid. So they trade on a public market. So it's easy to get in and out of. That's one of the biggest things a lot of people forget with trading or investing is it's all good and well to be able to buy into it and get into it. But if you needed to get out of it quickly and liquidate or exit your position, sometimes you've got to do that, and you can't find someone who you can sell to or who's going to buy them off you. There might be some people, but they'll offer very low prices or ridiculously low because they know that they've got you in a bit of a bind. So that's one very important thing is liquidity. You'll find with the traditional investments like the ones we've got here, they tend to have a very good correlation to markets as well. So they tend to track whether certain markets across the world are doing well or not doing well at the same time. Whereas if you look at the alternative investments, you tend to find that there's potential there for illiquidity. So it is difficult to get out of, or the price might fluctuate wildly, or even the difference between the buy and the sell price on the market, if it does trade on a market, can be quite wide. So often they may be unlisted, or they might also trade on private markets, which doesn't have that much transparency. They may not have much of a correlation or relationship with markets. And that could be something you may want to consider, like in terms of investing in artwork, like Evan was mentioning. It is good perhaps to have something that is a bit removed from markets itself, but you just want to be careful. You don't want to put too much of your assets, you don't want to allocate too much of your cash towards something like that. Sometimes you can have a lot of people who are active shareholders in those alternatives, which means that they could be solo owners of particular assets and have a lot of sway over the price. Basically, a lot of the alternative investments that you see, they're usually focused on inefficient markets. So just keep that in mind as well. And there's another question here from Aaron, and it's basically talking about a core and satellite approach strategy that you'll see in the bootcamp coming up in modules later on. But he's talking or asking, is taking a core and satellite approach using various ETFs, so exchange traded funds, is it possible to hold too many satellite ETFs in a portfolio? So basically, just to quickly touch on the strategy itself, the core and satellite, think of it as you've got at the core, you've got a passive approach like these InvestSMART diversified portfolios. But then you've also got little satellites on the outside, or little opportunities where you could actively, as in trying to outperform the market, have some investments as well. It does come down to what kind of percentage or split you want to have in those two different core and satellite areas. It depends purely on your circumstance. You might have someone who is 70% passive, so they'll have something like a InvestSMART diversified portfolio at the core. 70% of their cash is sitting in something like that, but then they might also have an actively managed or even active type ETFs on the outside. So it comes down to that split to begin with, but then also what kind of ETFs you're putting into the satellites. So depending on the cash you've got can also come into it. If you've got very small amount of cash to put into the satellites, you could potentially have too many ETFs in those satellites, because you're paying brokerage. All the costs based on the size of your investment are basically eating into any potential return. There's another question here too from Sophie, and it talks about, are there any benefits to using one trading platform over another? So for example, NavTrade. There can be. I haven't, to be honest, sat down and actually gone through all the different brokers that offer different trading platforms. Essentially, at the end of the day, what you want is a broker that charges you reasonable commission, because that's a very big part of your investment as you go through it. You don't want to be, say, buying $500 worth of shares and having the commission be $29. Because if you decide to buy into it and then even a year later you decide to sell out of it, you're going to pay commission as well to exit. And that's $60 just for that one $500 investment. And even at the broker I used to work at, I did see that happen quite a lot. And someone who would make 10% back on their trade, they would say, oh, I just made $50 profit from buying at this price with my $500 and selling it at $550. So I've made $50 profit. But then they turn around and say, oh, but I just lost. I paid $60 overall in brokerage, so I've actually lost $10. So all you're doing is making the brokerage company richer. So that's probably one of the most important things, is just finding out how much the brokerage is. Some of the banking type related brokers, they'll give you certain discounts or deals if you hold accounts with them. So definitely investigate that. You also want something that's easy to use. So I've used ComSec in the past. I used to use E-Trade. I've used a few of those. They're straightforward, easy to understand. If you need help, it's there as well. Some of the cheaper brokers that you can go through, they don't, particularly with CFD providers, unfortunately, they want you to be in their CFD products, which are highly leveraged, speculative. That's where they make all their money. They don't make much money off, or if at all, from their stockbroking side. They won't give you too much attention or help if you need it. It's just basically one of the ways they get you into the more lucrative products for them. So just keep an eye on that as well. So I don't seem to have any other questions at the moment, but if you do have a question, you can always ask us later on down the track. There's an email address here that you can actually ask questions to or comments, and it's bootcamp@investsmart.com.au. And make sure you register for the next week's webinar, and there'll also be one coming up on the Friday next week as well, which would be the 18th of September, where I'll have Evan Lucas on board and we'll talk about trading psychology or investment psychology. This will be uploaded as well onto the Bootcamp platform, so you can watch it again at your own pace. But until next time, thanks so much and have a lovely day.